One of the hottest stocks here on the YouTube platform, in the YouTube community, is Carnival Stock, Carnival Cruise Line, ticker symbol CCL. And this is because Jeremy from the Financial Education channel has recently started buying the stock. He's made a video here on how he plans to build this into a $100,000 position. And because of this, a lot of subscribers have come to me and asked, what do you think about Carnival Stock? So finally, you guys asked for it. I'm going to make that happen in today's video. We're going to discuss Carnival Cruise Stock, and I'm going to show you exactly what these other YouTubers find interesting about this company. And then I'm also going to share with you at the end if I plan to buy this stock for my personal portfolio or not. As always, the best way you can thank me for these kind of videos is by just dropping that like down below. Let's try to get 250 likes on this video. But either way, let's get into it. Carnival, in a nutshell, is the largest cruise line owner in the world, and they own many sub-brands like Carnival, of course, Princess, and other local lines around the world. And there are really three main things that appeal to me when it comes to this particular stock. The first is that it's currently sitting at around 45% from its all-time highs. The second is its dividend yield, which is currently bringing in over a 4% yield. The third is that it appears to be a pretty good stock when it comes to its fundamentals, so we're going to be looking at that as well. Now, of course, the first two reasons kind of go hand in hand. When a stock price drops, the dividend yield rises, which is why we're seeing some good value in this aspect here in Carnival stock. Here we can see that Carnival Cruise Line has taken a nosedive recently, down near 45% from its highs. And on the monthly chart here, I like that it's sitting on its 200 moving average, which is typically seen as the last line of defense, usually the strongest line of defense, and it's typically where most stocks find their bottom. I personally find a lot of value at these levels in stocks, not just in Carnival, but other stocks that I bought previously. So this was the first thing about Carnival that appealed to me. Now, a lot of the sell-off in recent days and weeks is due to the coronavirus, as that is surely going to affect travel and as a result affect their Q1 numbers. But this is a short-term issue, and long-term investors should use this as an opportunity to potentially open or build a position if they are interested in Carnival Cruise Lines. Now, most recently, a Carnival cruise ship did go into lockdown mode with 7,000 people on board, and this was because there was suspicion that there was coronavirus on board, and of course, this resulted in the stock price taking a nice 5% haircut on the day. And personally, I like buying stocks or adding to my position when we see things like this in particular companies, when it's just news-driven, fear-driven, panic-driven. There's usually a lot of value there when you scoop up shares because that recovery more often than not comes pretty quick. So that was kind of the chart for Carnival. Now looking at the dividend, here we can see that things appear very attractive once again. Starting yield is a juicy 4.3%, and it's growing on average nearly 15% year over year, which is again a nice growth number to see in a dividend stock. Now you couple this with a reasonable payout ratio of 44%, and we have a fairly sustainable dividend for the foreseeable future. But there is one big caveat. In the last year, the dividend came to almost a screeching halt with a raise of only 2.56%. So this could be a sign that they may not be raising this dividend much in future years either. Also, you can see here that they don't have the best history with maintaining that dividend. During the last recession, they cut it quite significantly, and we've only been seeing some real growth of the dividend here in the last few years. Now, you have to also consider that we are in the late stage of an economic cycle, and this means that a recession is most likely closer than it is further away. And the real question that investors are asking now is, will Carnival continue paying that dividend, or will they actually cut that dividend like they did during the last recession? If they do end up cutting that dividend, the stock price will take an even bigger hit, in my opinion, and that is because dividend investors will be selling out of their positions. So yes, the dividend appears attractive today, but if you're looking at a long-term dividend growth company, I don't really have a lot of confidence that Carnival will be that stock. It's just nice to have that 4% yield right now. But the real story, the real growth part in this company where you're going to actually make money in is going to be on the capital appreciation side, in my opinion. Okay, so now let's get into the serious stuff, which is their fundamentals. What I like about Carnival here is that they are a growing business. you look at their revenue, you can see that Carnival over the last 5 years has had a consistent growth rate year over year, with 2019 setting yet another record for the company. This is a healthy sign that the company continues to grow and is doing things that attracts more customers year over year. Now, one red flag I noticed when looking at their spending, in other words, their capex, in 2019 hit a new record of $5.43 billion, and this has been increasing substantially year over year. This is not a good sign, and this will affect their free cash flow or their cash in general and other aspects of the business, which affects their overall financial health. Now, like I said, free cash flow will be affected, and in 2019 we did see that, with almost a negligible free cash flow for the year, coming in at a measly $46 million, which was down 97% year over year. Investors have taken notice of this. Now, some of the free cash flow is actually used to pay down debt, which is understandable, and I think as an investor you want to see a company do that. But some of it was used for other expenses, which as an investor you need to keep a close eye on. I understand that maintaining ships and buying ships are not a cheap expense, but at the end of the day, investors care about balance sheets and free cash flow. Expenses will be forgiven occasionally, however, when it makes the free cash flow numbers look this poor, it does reflect in the stock price. Now, the PE for this company is also a very interesting story because it shows us here that this company is very undervalued. Here I've put the average EPS estimates from analysts in 2020 and 2021, which shows growth, and then calculating the forward PE with these values, it gives us a 9 forward PE. Compare this to the company's historical PE of 16. This is a significant discount that we're seeing in the stock right now, and it's clearly undervalued from this metric by a big margin. But again, remember that free cash flow reduction is definitely playing a role in this cheap valuation because investors are afraid that Carnival may be struggling in the future if this negligible free cash flow continues. Also, I mentioned before, since we are in the late stage of an economic cycle, if we do enter a recession, these are typically stocks that get hit very hard because one of the first things people stop doing when they are in tough economic times is they cut out their vacations, they'll skip a vacation for the year, and that affects Carnival directly. However, one good thing for this stock or this company is that they are a global company. So even if the US experiences a recession and a slowdown, they still have the rest of the world really to help grow their revenues and their profits year over year. But don't be fooled, they will get hit quite significantly on their balance sheet if a recession does happen soon. So now the real question, after we've gone through all these details, am I interested in buying Carnival stock here at these prices? Honestly, guys, I'm kind of undecided here with this company. I like that the dividend yield is a good amount, but at the same time, I don't think it's going to be very sustainable moving forward. And like I said, if we hit a recession, I think that actually will get cut. I like the current price of the stock, and I like that it's sitting at its 200 moving average. That actually does show me that there is some value. There's a lot of pessimism in the stock right now. And even if I buy a small position now, I think there'll be a lot more upside than downside. And historically, their free cash flow has also been pretty good. Maybe this was just an exceptional year for them where, just put that aside, ignore this year. Hopefully 2020 gets back to a nice free cash flow growth number, but that's not really a guarantee, and that's kind of the bet that you're making by entering the stock here at these prices. So I think this stock really in a nutshell does carry some risk, but a lot of that risk is baked into the stock price right now in my opinion. It's almost priced as if a recession is about to hit or has already hit. So there may be more upside here at these current prices than there is downside. And because of that, I may enter a position at some point, but I still need to do more research on the company to make sure that I feel 100% confident before putting any money into this stock. Now, if you guys want to see a follow-up video, if I do end up buying a position in the stock, again, drop that like down below so I know that these kind of videos interest you and you want to see more of them in the future. Guys, thank you so much for watching. Don't forget to subscribe if you're brand new here. But either way, I'll see you in the next one. Peace.